The new Fed chair just went on global television and told every American that inflation is going back to 2%. And the very same week, 140 of the biggest companies on earth, think Visa, Mastercard, BlackRock, Google, announced a brand new digital dollar that will quietly reset the financial system. That's what Winston just told me, his research. And honestly, those two things are very connected. And when you see how it changes how you might want to invest from this day forward. So this isn't a conspiracy, it's literally in the legislation, it's in the press releases, and almost nobody is connecting the dots. So if you understand what's really happening, you can position your money on the right side of this. And if you don't, you'll be the one paying for it through like a silent tax that's already eating your savings and some of your investments right now. So by the end of this video, you'll understand the 3-move playbook Washington is running on your money, and I'll give you a simple framework to protect and grow your wealth while you do it. My name is Felix Prehn. I'm an ex-investment banker, and that back there is very sleepy Winston, because we did a hike this morning, didn't we, Winston? Up, 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 up. Yeah, no reaction from that guy. He's like, no, I'm not moving. So we're also the founders of the GOAT Academy, where my retired Wall Street mentors have taught thousands and thousands of regular investors institutional strategies, over 20,000 the last 6 years or so. And what we do here is to pass you the knowledge that's usually only taught to Wall Street bankers. So today I'm going to show you the quiet 3-part machinery Washington just switched on, and how to make sure you're on the winning side of it and not the losing side of it. Now, I have to be honest with you, the video is going to be pretty information dense. They're going to be numbers, they're going to be laws, they're going to be connections that most financial media won't make for you. And to make sure this really lands for you, because it's that important, I'm going to give you a full bonus research report on everything we're covering here today, plus much, much more, so the video doesn't become insanely long. And you can download that for free at felixfriends.org/Fed. Link is in the description down below. But before I show you the 3 moves, you need to understand the size of the problem Washington is trying to solve. I don't know why I'm doing that hideous Spanish accent, but when you see the maths, everything else clicks. So the US is sitting on about $40 trillion in debt, and that's a number so big it's meaningless, right? That means absolutely nothing to you and me. If you earned $1 every single second, and you never slept and you never stopped, it would take you 1.2 million years to count to this 39 trillion we have right now. That's how much the government is. Again, it's a meaningless number. But the part they don't put in the headlines is this. The interest, so not paying anything off, just the interest is over $1 trillion. 3 billion a day. Imagine what you could do with 3 billion a day, right? Imagine the impact you could have with that. So the government's got a problem, and it's getting worse every single day. And there really are only 3 ways to deal with it. You can cut spending, good luck with that. You're going to be out of office before you can say, let's be fiscally responsible. You could raise taxes, it's also very, very popular. So that's never going to happen. Or you can do what governments have done for centuries or millennia even. You can inflate it away. And that third option, that's exactly what's happening right now. And the new Fed chair is just sort of smudging it over so you won't notice. And they found a very, very clever new way to do it. And let me show you the first act of it. The move number 1 in the government's playbook is this. You say the right words. The brand new Fed chair, Kevin Walsh, just made his first international appearance. He was at the European Communist Bank Forum in Sintra, European Central Bank Forum in Portugal. And this was a big deal. The whole world was watching. Every financial analyst in the world was watching. And here's what he said. He said the Federal Reserve will not be comfortable with inflation above 2%. He said he would deliver price stability. And guess what? The market kind of loved it. But here's what I need you to see, because this is where the magic trick happens. At the very same meeting just 2 weeks earlier, the Fed's own forecast, their own numbers, not my numbers, their numbers, said inflation is going to be 3.6% this year. Yeah, 3.6% this year. Now, according to the same government's official real data, it is currently 4.2%. Now, I don't need to tell you that governments suppress inflation data, right? They make it up, basically. So in reality, of course, it's much, much higher. So they say 2%, but it's really more like 4% plus. It's a bit like going to the doctor, and the doctor says, we're aiming for a healthy weight. Very reassuring. And then he hands you a second slice of cake. So the words say one thing, but the reality and the actions say something else. That's actually what's happening here. Now, why would they do this? Why would the Fed chair go on global television and, I was going to say lie, obviously that's the wrong word, promise 2% when the facts are clearly something different? It's because of those 39 trillion. Think about it. Inflation stays, say, at 40%, 4% even, Freudian slip, and interest rates stay around where they are right now, 3.5%. Then in real terms, after inflation, the cost of serving that debt is actually slightly negative. It doesn't actually cost anything. So yes, it's growing on paper, but in terms of real dollar value, purchasing power, it's actually shrinking. And that's a weird concept. But every year that inflation stays above the interest rate, the government's debt gets a little bit smaller. Now, who pays to make it smaller? Well, you do, congratulations. It's through higher prices on everything you buy. It's a tax. And this is not new. This is not something that Walsh and Trump just came up with. Governments did exactly the same thing after World War II. The government came out of the war, the US government, with massive, massive debt. 106%, which is pretty similar to where we are right now. We're at about 123% right now. So how did they bring it down? They didn't pay it off. No. They kept interest rates low. They let inflation run a little hot. And over the next 20 years, the debt shrank from 106% to just 23%. Now, economists, I'm one of those, I apologize for that, we call it financial repression. I think silent tax is probably the better way of putting it. So that's move numero uno. There's that weird Spanish thing coming back. I can literally say mojito, and that's about it in Spanish, but you know, it's a beautiful language. So what they do is they look confident, they keep the market calm, and meanwhile, inflation quietly does the dirty work. Now, know what's happening in your head right now. You're hearing all of this, the debt, the inflation, the $1 trillion interest bill, and you're kind of thinking, okay, great info, but what do I do about it, right? Like, do I sell my tech stocks? Do I buy more gold? Do I buy the dip? Do I chase the rally? Do I move to cash? Do I just close my laptop and pretend none of this is happening, right? And that feeling there, that kind of overwhelming feeling, that's exactly what Wall Street's counting on. Because when retail investors don't have a plan, they do one of two things. They panic sell at the bottom, or they freeze and do nothing while the smart money scoops up all the bargains. And either way, you lose. And look, I get it. There is more financial data available today than at any point in human history. You could watch YouTube videos on this till you drop dead, but more data doesn't actually mean better decisions. Right? Most of the time, it just means more confusion, more news, more... I have a plan already. I've written it out. I have my exact strategy for what I'm doing literally for the rest of the year written out. And I want to share that with you because I think in your portfolio, there are things in there that are broken. And I think you won't find out that they're broken until it's too late, probably sometime later this summer, around about end of July. So I could give you a document, but I know it won't land because no one's going to read like 68 pages of something. So instead, I want to do an actual teaching session. So I'm going to sit you down for 2 hours and walk you through the exact process. Why I'm doing what I'm doing, what the institutions are doing, what I learned from my Wall Street mentors. All my mentors are guys who worked in the big financial institutions, investment banks, hedge funds, and so on, so that you have a playbook of what to do about this and that you can use that till the end of time. And some of you are going to be, okay, I want to learn this. And some of you will be, well, in a few months going, I wish I would have learned this 6 months from now. So if you want to join me on that live session, it's completely free, no catch. Grab yourself a free seat. I call it Why Your Portfolio is Broken. That's the workshop name. And you can sign up at mygreatportfolio.com. because we want to make your portfolio great again. And no, that's not a political statement. It's just a bit of a fun with words. So go to mygreatportfolio.com. Link is down below again in the description. It's completely free, no credit card, nothing like that. Just a teaching session. Show up for yourself on the weekend. If you're going to show up for yourself on the weekend to learn, then write, I want to learn in the comments down below and let us know. And I look forward to seeing you. Now, act number 2 is called the Genius Act. And it's the law nobody talks about, and it's genuinely genius. In July of last year, El Presidente signed a law called the Genius Act. It stands for Guiding and Establishing National Innovation for US Stablecoins, which is really weird. But what is a stablecoin? Well, it's very simple, really. It's a digital token. Think of it like a digital dollar. It's basically the same value as a real US dollar. You put in $1 and you get a token worth $1. Now, why would you want to do that? Well, if you wanted to have your dollar back, you just hand in the token. That's basically it. So it's kind of like a piece of paper, but it's digital. Now, the part that matters is this. The Genius Act says every single regulated stablecoin issuer in America has to back those tokens with something real. And not just anything real, but very, very specifically US debt. They call them T-bills. So read this again because it's important. The law says if you issue a stablecoin, you must buy US government debt. It's not a suggestion, it's literally the law. So what did Washington just do? They created a legal requirement for a whole new category of buyers to purchase government debt. And that's not an accident. That is the design. Now, how big is this? Well, the scale is probably where your jaw is going to drop. The stablecoin market today is about $320 billion. It's a pretty big number, right? But here's where it gets wild. Do you know Tether? Maybe you've ever owned one of those USDT stablecoins, the biggest stablecoin in the world. Tether holds about $141 billion in US government debt. That makes Tether the 17th largest US government debt owner on the planet. Bigger than most countries. Literally, a crypto company holds more government debt than nations with centuries of history. And it's going to grow. It's going to hit about $2 trillion by 2028. And that's huge new demand for US government debt. Why would they do this? Well, when you have more demand for government debt, it lowers government interest rates. It's cheaper for the government to run a big deficit if everybody wants the debt. So they're creating this artificial demand. So stablecoins and this Genius Act make it cheaper for the government to keep running its present Ponzi scheme. Sorry, a fiscally slightly irresponsible path. And just when you thought it couldn't get any crazier, this happened. On June 30th, just days ago, 140 companies announced a new stablecoin. All together. It's a consortium. It's called the Open Standard, which always makes me feel warm and fuzzy inside. And the token is called the OpenUSD or OUSD. Now, when I say 140 companies, I don't mean 140 crypto startups you never heard of. I mean Visa, Mastercard, American Express, BlackRock, Stripe, Coinbase, Google, Samsung, IBM, Shopify, DoorDash, Western Union, Standard Chartered, SoFi, Ripple, Solana, all of them. This is without exaggeration the largest corporate alliance in the history of financial services. 140 plus companies, from payments to banking to crypto, they're all building one stablecoin together. Now, why would these companies do this? What's in it for them? Well, here's the part that should make you sit up in your chair. Under the Genius Act, stablecoin issuers are banned. It is illegal from paying interest to the people who hold the stablecoin. So you, the holder, get zero, nada, nichts. But the issuer takes your dollars, parks them in government debt, and earns interest on it and keeps it. So if OpenUSD reaches, say, $100 billion, which with these partners is kind of not a crazy number, this consortium is going to earn interest on the $100 billion. So that's about $3.5 to $4 billion a year in literally zero risk income. So yeah, you get a split that costs 140 people, still a lot of money for everybody. So that's the business model. You give them dollars, they buy government debt, they earn the interest, you get a token, and the government gets a permanent, growing, legally captive buyer for its debt, and your money is now perfectly trackable. Congratulations. But the saver, holding cash, who watches inflation eat their purchasing power away, they're the real loser. Now, I want you to zoom out for a second, because this isn't really about crypto. Crypto is just a vehicle. What's really happening is that Washington has figured out how to create permanent demand for its own debt. So it solves Washington's biggest problem, because the real risk with, $39, $40 trillion in debt, it's not the size of the number. It's what happens if nobody wants to buy the debt. The buyers disappear, interest rates explode, and you get this debt spiral, and stablecoins are the insurance policy against that government nightmare. So the more crypto adoption we get, what happens? More stablecoins get made, more government debt gets purchased, and therefore we get cheaper government borrowing, and therefore the government will likely borrow more, and then we start and rinse the problem once more. But there is an Act 3. And if you're starting to get a little bit worried about this, I think you should be. Come and join us on the weekend, and I'll teach you how not to be worried about this, because this is also a big, beautiful, shiny opportunity for those who know. Wall Street knows, but Main Street doesn't. So let's fix that together, right? Share that link, mygreatportfolio.com, with anybody who think might find it helpful. And let me give you the final piece. Act 3. This is where everything comes together. Now, you've probably heard the phrase, strong dollar policy. Every Treasury Secretary says it, every president says it, we believe in a strong dollar. It's like saying, I believe in apple pie. It's kind of meaningless, but nobody will disagree with you. Now, but what if the actual plan is the opposite? There's a framework floating around Washington. Some people call it the Mar-a-Lago Accord, named after the president's pool house in Florida. And it was outlined by a chap called Stephen Myron, who now chairs the Council of Economic Advisors. And the core idea is this: the US dollar is overvalued, and a controlled devaluation of, say, 20 to 40% would fix the trade deficit and revive American manufacturing and exports. Now, I don't think they're going to come out and go, we're going to devalue the dollar. I don't think they're ever going to say that. But the three moves together already achieved the same thing, just gradually. Move number one is you promise a 2% inflation while you're letting inflation run at 4%. That's dollar devaluation, but it's by another name. Your dollar buys less every year. Move number two is you create captive buyers for government debt so that the interest rate on that debt stays low, because if lots of people want to buy it, the government has to pay you less, right, as interest. And that means the government can keep borrowing without the bond market going loony. That's already happened. Move number three, we let the dollar slowly, quietly lose purchasing power. The debt, the 39 trillion, is dollar debt. If those dollars are worth less, the debt is worth less. It sort of melts like ice cream in the sunshine. It's exactly the same playbook governments used after World War II. Keep rates below inflation, let the currency do the work, and the debt will shrink in real term over the next 10, 15, 20 years. And the people who pay for it are the savers. Yes, the responsible, safe people with cash. The people in low-yield savings accounts and low-interest long-term bonds. The people who own salaries, right? You fall into one of those categories? Very likely you do. And some people benefit. They're the people who own assets. Real estate, gold, quality stocks, things that rise in price when the dollar falls. That's the divide. And which side you're on is really rather up to you at this point. So don't go out ramping and raging about this. We'll do absolutely bugger all. Every political party will implement the same playbook because it's the only choice for them to stay in power. So now you see the machine, right? Three moves, promise 2%, build the buyer, let the dollar shrink. So the question is, what are you going to do about it? So let me give you a simple three-step framework for you. And we're going to go much, much more specific on like what we actually buy and sell and so on. If you join me on the weekend in the live training, again, links down below. But the beauty of this is it doesn't depend on timing the market or picking the perfect stock or predicting what the Fed does next quarter. It's about positioning yourself on the right side of the trend that is already in motion. So step number uno, don't hold too much cash. Yes, you want to hold an emergency fund, generally speaking, 3 to 6 months of hard expenses. So I'm not saying empty your savings account completely. You need some emergency funding. But anything beyond that, cash is the thing that devalues. Every dollar sitting in a checking account earns 0.5%. Inflation officially runs at 4%, so you're losing 3.5% per year. Now, I actually think your loss is much greater because the S&P went up, 17% last year? The year before that, it was 25%, I think. The year before that, I think it was 24%. So actually, if you were in cash, you lost 24%, then 25%, then 17%. So you've lost almost 100% of the value of your money, or rather you would have doubled it. So inflation is what the S&P does. That's my book. So cash is an ice cube on a warm counter. It looks kind of safe, and then it disappears. The warmer the room gets, the quicker it disappears, and higher inflation is basically the room getting hotter. So that's step Nummer 1. Yes, I am German. I apologize for that profusely. But step 2, own things that go up when the dollar goes down. So what goes up when the dollar goes down? Hard assets. Real estate. Good real estate, obviously. Gold. Well, there's only gold. There isn't good or bad gold. Not necessarily in the short term, because in the short term, metals prices are set by the lunatics who run the commodity exchanges. And third, buy quality stocks with pricing power. What's pricing power? It's the ability to raise your prices without losing your customers. Think about it. If a company can pass on higher costs along to their customers, then inflation doesn't hurt them. It might even help. When we got post-COVID inflation, Pepsi said, we're going to raise our prices because of inflation. They raised them by 17%. Profit margins increased. And the sugar-addicted soda crowd kept buying Pepsi because they were like, I need it, right? So how do you spot these companies? Well, you look at 3 numbers. Gross margin is the company keeping a big chunk of every dollar. And there are actually loads of these companies, and I'll put them on the screen for you here. We have an app for this called the Winston app. Winston built it, obviously. I call it moat. That's the best way to kind of summarize that. Just look at the companies with a moat 10 out of 10, and you can filter for those, and you can even look at European stocks if you must, or French stocks, or Polish or Australian stocks, or whatever. It's all in there, and you can literally set up filters for it specifically. But easiest thing to do is just look at the moat 10 out of 10. That tells you they have pricing power. We then also look at a bunch of other things. So if I pull up a company here at random, let's say Datadog, doesn't have a great score from us overall. Dilution might have something to do with that, but that's beyond today. We also see the politicians' trades in it and so on. But really what we want to look at is cash flow. Is it improving? Is it strong? So are they generating real cash? And then is the balance sheet kind of good? And there's a lot of data in here, but you can just look at the summaries. But yeah, definitely cash flow and the sort of stability factor. You want those to be pretty decent if you're looking at a company that actually has pricing power. I'll put a link down below into the comments for a free trial for the app if you want to try it out. If you don't like it, just cancel it before the end of the trial, and that way you're never going to get billed. So my golden rule is quite simple, really. If you can't explain what a company does and why it makes money to, say, a 12-year-old, then you probably shouldn't own it. So complexity is not what we're looking for. We're looking for something very, very simple, which is why we have scores. So you can just click on highest rated stocks up here, and then look at the ones with the highest score, and there are probably some ones that you might want to have a look at, because there's some really, really high quality businesses out there, whether you like them or not, and then you can go a little bit deeper into that. And then step number 3, and this is where I'm going to lose 99% of people, but you're still here, so probably not you. We just learned that stablecoin holders can't earn interest. The law literally bans it. So where does that interest go? Well, it goes to the stablecoin issuer, to the platform, to the financial infrastructure companies that sit between you and the debt market. So ask yourself, who benefits from the stablecoin booms? Well, payment processors, financial exchanges, custody providers, companies that move money, store money, or help others build on top of stablecoins. So I'm not telling you to buy any specific stock here, it's your call, but I'm telling you to think about positioning yourself near the flow of money, not away from it. When there is a gold rush, you can dig for gold, or you can just sell pickaxes. Typically, the pickaxe seller is the better investment. And look, gold isn't a bad idea either, in my humble opinion. central banks around the world have been hoarding gold and buying it at the fastest pace in decades, they see the same things that you now see. They know what a weakening dollar means and they're acting on it. So let's bring it all together quickly. The 3-move playbook. Move 1, promise 2% inflation while the math says 4% or a lot more. Move 2, build that legally required buyer for government debt, the stable coins, genius, I know. And then let the dollar lose value slowly so nobody freaks out and it sort of melts away the debt in real terms. And that's not a conspiracy theory, it's already happening. Move 1 was announced, move 2 is law, and move 3 is the logical consequence of move 1 and 2. So the question isn't whether it's happening, the question is, are you positioned on the right side of it confidently? The people who understand this will own assets that will rise more than inflation, and the people who don't will hold stuff that doesn't, and they'll get poorer and poorer and poorer. And it's really serious. It really is very serious. So if you get the big picture, but you still don't know exactly what to do with your portfolio or every single stock in there, that's exactly what the live training is for. So I'm going to sit down with you this weekend for 2 hours, walk you through the exact positioning, what the institutions are doing, help you build a plan. So grab yourself a free seat at mygreatportfolio.com. Link is down below in the description, and it is completely free. And I promise you, Winston will be there. Winston, come on, sleepy bear. Come on, Winston, come. He is too sleepy, he doesn't want to. No, he's like, I had a tough morning. It was hot outside. It was actually very hot outside. But there he is, you can see him looking very sleepy. So we shall let him sleep. If you got some value out of this, my only ask would be share the link down below, the Migrate Portfolio, with other people who you think need to understand this. And I wish you a tremendously successful year. If you're invested in gold or silver, there are two things screaming at you right now at the same time, and they completely contradict each other. One side is saying gold's going to $10,000, US